Welcome. Today we are going to be creating a balance sheet from a set of information that we have about a particular company. This information is the same information that we had when we created the last profit and loss statement in the previous video. When we make financial statements, we make them together to be able to create a clear picture of the financial position of a company at that time. So we'll often get one set of information and use it to create both a profit and loss statement and a balance sheet. Just like with our profit and loss statement, we always start with our company name, followed by which statement this is. Today it is a balance sheet. Finally, we have our date. A balance sheet, as described in our previous video, is a picture in time of a business, of what they own and what they owe. And so our date is written as of, and then the date, in this case the 31st of December 2012. So, next we need to go to our information and see what's useful. Most of the first part of the information was used in our profit and loss statement, and generally information is not used or put on both statements. Remember, as I said, things like revenue and expenses are never shown on a balance sheet, and mostly because they are shown on the profit and loss sheet already. So our first set of data is not needed. Our second set of data, well, we did use it on our profit and loss statement to help us adjust our cost of goods sold. It is also shown on our balance sheet because it is stock. Okay? Our stock is like our inventory, and so these are items that are currently, it'll be this item here, what's currently left in the inventory at the end of the year. This means these are physical items sitting in our business that are worth a certain amount of money. Okay? We own these items, so it's going to be an asset, and they're items that we should be able to sell in less than a year, being inventory, and so they are something that is going to go under current assets. Stock is 12,000. Okay? If we go through the next bunch of these, were all things used in our profit and loss as expenses, so we don't need to include them, and we can just remove them. Okay. Next, we look at our bank loan. We took out an £80,000 bank loan. And remember, a loan means we owe the money, so it's going to be a liability. And being a large bank loan, it's going to be something that we will have for the next few years, so it's going to be a long-term liability, and we say a bank loan there. Okay? Well, we took out an £80,000 bank loan. 80,000 is not what we're going to put in here, because here should only be included the amount that we are currently, at this date, December 31st, owing. We originally had an £80,000 bank loan. However, throughout this year, we have repaid £1,000 a month. So, at this point in time, on December 31st, at the end of the year, we will have repaid back £12,000. And so currently we are owing £26,000, and that's the amount that gets included. Next, we see that we have £105,000 worth of, in this case it said fixed assets, so that's nice and easy. We just put this number in here. Okay. And we have this thing called depreciation. We included depreciation as an expense on our profit and loss sheet. However, it is something that also needs to be included on our balance sheet. Just to recap, we purchased this item for £105,000. However, a year later, we are most likely not going to be able to sell it for the same amount. Think, for example, a car. If you purchase it one year, you're not going to be able to get the same amount that you purchased it for at the end of the next year. We need to include the amount we purchased it for on the statement. However, we are basically lying if we just leave it at that, because today we would not be able to sell it and get this much money. And remember, on our balance sheet, an asset is something that we could sell and get money for. It helps us see, would we be able to sell all our items and get money to pay off all the money that we owe. So we need to deduct from it what we call depreciation, or the amount that we used up this year. It's 10%, and in our profit and loss we calculated that that is £10,500. And so, like I said, we take our original amount and we subtract out that depreciation to get the new value. This is what those fixed assets could be sold for today. Okay, next we have some money that we owe suppliers. It says right here, owe, and so therefore it is going to be a liability. It's money we owe to suppliers, and so they're going to want that money usually within a month, which is definitely less than a year, and so we're looking to our current liabilities. When we owe money to suppliers, we like to lump this into one number because we could have a lot of suppliers, and we call this creditors. Okay? 15,500. The reason it's called a creditor is because these suppliers let us buy on credit. They gave us the item and said, you can pay us in a month's time. And so that's that number there. Also included here says that we are owed £41,000 from our customers. Okay? Is somebody owing us money? That is something we consider that we own. Okay? It's something that we're going to get money for in the next year. So it's a current asset. And it's something that we call debtors. These people owe us money. They have a debt to us, and so we call it debtors. 41,000. Okay. Next, we have our cash in the bank. Obviously, cash, we own it. It already is money in the bank, quite easy to turn into cash in our hands in a short amount of time, so it is found under the current assets. So at this point, we have included all the information we had for this top section, so we just have a few calculations to do. First, we need to add up our current assets. So we're going to take each of the numbers and simply add them together to get a total there. The next thing missing is something that we call working capital. Working capital is basically what we have to work with on a daily basis. Okay? Our fixed assets, we said, are things that we're not going to be selling anytime soon. So that's not something we really work with on a daily basis in terms of paying bills and having money. Our current assets, however, are things that will be turned into money. So that number is included. Also, our current liabilities are things we're going to have to pay soon. So that's included as well. Your working capital is calculated by taking your current assets and subtracting from it your current liabilities. In essence, this is the amount of money that you could get in a reasonably quick amount of time to do business. If you sold all your current assets, which we said you could quickly and got cash for them, and then paid off all those current liabilities, the things you owe in the near future, this is the amount of money, your working capital, that you have to work with. Finally, we have something called our net assets. If you recall back from our earlier presentation of why a balance sheet is called a balance sheet, when we were looking at a picture of scales, we said that all of your assets minus all of your liabilities had to equal your owner's capital. This first section is just looking at your assets and liabilities. Okay? And so this total net, remember net's usually your end number, assets is going to be the total for this section, and in essence the number that we need our owner's capital to also be to make sure that we balance. Okay? You can calculate it two ways. First and most simply, we know that it's all of our assets. So we take our fixed assets and we add to it our current assets. All of our assets minus all of our liabilities. So then we subtract our current liabilities and we subtract our long-term liabilities, which gives us 81,180. Okay? Alternatively, we can calculate it a different way, which gives us the same answer, where we just take our fixed assets, we add to it our working capital, and we subtract from it our long-term or fixed liabilities, using everything in the right-hand column. Again, gives us the same number, whichever one you choose to use. This is our first section done, and we know it's the end of a section because we have this double underline. So all that's left to do is figure out our owner's capital and see if we, in fact, balance. Generally, we take our opening capital from what our end owner's capital would have been on the last statement that we did. However, in this case, it's a new company, so that number is going to be 0. Okay? We know that our owners invested from elsewhere on this document that we've already seen when doing our assignment, that the owners invested £25,000. So we're going to put that in. Next, we see profit. And I know at this point you're thinking that I'm a liar because I told you that revenue and expenses and profit are things that don't show up on the balance sheet. The reason we say that is because a balance sheet is not used to figure out our profit. That is what a profit and loss is for. However, if you recall, owner's capital is all about how much the company is worth to the owner. Okay? If we took all the things that we have and sold them and paid off all the debts we have, what would be left? What would the owner get? So each year when we make profit, this needs to be accounted for. Okay? This adds to that bit that the owner would have. It goes in the bank that they could go and take out. So here we can simply put equals and go back to our profit and loss statement and take our profit and bring it over. Okay? This step is the step that ties our two statements together. And this step really shows you that you're going to be able to tell not only if the balance sheet is correct by it balancing, but also that your profit and loss statement was correct. This also reiterates the fact that we definitely need to be doing both statements each time, not just to show a full picture, but because they do rely and link into each other. Finally, we have something called dividends. So if we look back over here, it says that each of the two owners have decided to give themselves $20,000 in dividends. So this is going to equal 20,000 times 2, which gives us 40,000. So it's the moment of truth for calculation. So we always start with our owner's capital. We add to it any investments, because remember that increases it. We add to it our profit, and we subtract from it money that's been taken out in the form of dividends. And, magically enough, we do balance. So we know at this moment that not only is our balance sheet correct, but also our profit and loss statement is correct. This has been a presentation on how to create a balance sheet using information about a specific company. I hope it's helped you in the process of creating your own.